Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. I apologize for the couple of minute delay for our start here. Well, let's jump right into it because between last week and this week, there has been a bit of a shift in terms of the market tone. Noticeable changes in terms of the risk on, risk off signals that we talked about here last week. Some of them starting to reverse a little bit. So we'll discuss kind of where we currently sit in the overall markets and what the overall signals are providing to us with regards to information. So when we refer to the S&P 500, we continue on this trajectory to the up over to the right. But the one thing that we continue to see with conjunction to that is the fact that momentum actually continues to fail to make new highs. So we continue to see lower momentum on the moves higher here, really turning more into a sideways motion rather than a upright motion. And this is definitely one of the concerns that we see here with the broader markets, especially given the fact that we've got such a long period of outperformance here relative to other sectors that has gone largely unchecked. So going for that long without some type of consolidation or pullback is atypical, and um, one of the risks that we currently see that continue to build with this equity rally. Now, last week we talked about the fact that the rally is starting to broaden out, which provides a better thesis for this rally to continue. That broadening out has stalled a little bit here this week, so we'll take a look at those charts here as well. But if you look at the NASDAQ 100, charts are very similar to this. Higher, but up to the right. But actually, if you look at the NASDAQ 100 for nearly a month, we really have much higher here, and that's why we continue to see momentum stall here, continue to trade lower lows, despite the fact that price action is still continuing to move sideways. So that's one of the biggest concerns that we see here in the broader markets. The Russell 2000, the small cap ETF. We talked about the fact that this broke out here above this 206 resistance level last week to new relative highs, but at the end of last week, we failed and we're back inside of that trading range. So at the moment, IWM in terms of small caps, more likely to be a range-bound play rather than the breakout that we really need to see for small caps to catch up with the rest of the markets in order for this to continue moving higher. It's definitely one of the biggest changes to whether or not we're on a risk-on, risk-off market environment that has changed from last week to this week. Looking at the equal weight S&P 500 index, we also talked about the fact that the equal weight index, we talked about the fact that the equal weight index provides us with the signal that the overall market has broadened out with regards to the rally over the past few weeks, which is good evidence of a potential continuation of the rally higher, but we did start to see that outperformance from the equal weight index start to show some underperformance. And that's really, again, a further concern that we see here with the equity rally when we look at the Russell 2000 and the equal weight index in conjunction with each other. When we see that kind of pullback, that typically means that the rally is no longer broadening out. And that certainly puts the market rally at risk if we continue to see that over the next week or two. When we look at growth versus value, we actually continue to see value outperform growth, even though over the past week or so, this has largely been flat. The trend is starting a little bit, still a little bit to the downside, but it's hard to ignore the bigger up trajectory here in terms of the bigger trend, which is the fact that growth continuously outperforms value. So we have had this month of underperformance for growth. Is it time for growth to kind of come back into play and start leading again? Certainly has the potential, and we'll take a look at individual sectors to try to answer that question. The big break last week has been on commodities. We talked about this breakout here a couple of weeks ago as a bit of a false break. We traded back into the range, but this week, on the back of gold's rally last week and oil's rally this week above the major levels, and we continue to see agriculture trade at relatively premium prices. This is really where commodities overall have broken out recently and will likely continue its overall strength here when you look at the dynamics that we see here across some of those major commodity prices, but oil being the big driver here this particular week of of prices moving higher, which is also going to factor into if you think about inflation prints that are coming down the line. We already had a hotter than expected inflation print last week. This adds more fuel to the fire with regards to inflation continuing to kick up a little bit higher, which would certainly keep Chairman Powell's rhetoric that right now we need to keep rates for higher and for longer without a clear change in terms. He did make a bit of a dovish pivot last week with regards to his testimony in Congress and his views in terms of whether or not we're ready to start cutting interest rates or not. So we'll see how that progresses with the FOMC meeting this week and the briefing that he provides as to whether or not there's further changes in terms of his language. But HYG, this is one of the signals that was firing off as a risk on signal. Basically, we had a long period of outperformance from high yield bonds, a period of consolidation, and we started to break out here to the upside. High yield bonds performing well is a risk on environment, but as you can see here, that breakout here so far has sort of failed to materialize and potentially kind of reverting back into the trading range. And that would certainly put us into a much more neutral view here overall, based on what we see here from high yield. Now, the VIX did spike a little bit here last week on the pullback that we saw, but right now we're settling around the 14.3 area. A small uptick in terms of expectations for future volatility. So put buyers demanding a little bit more put protection and sellers selling it for a higher price. And that's really what we're paying attention to here right now with regards to the fear index. The 10-year yield is trading back above 4.3%. Again, this is on the back of the hotter than expected inflation print last week. As we continue to see commodity prices rise, that will continue to put a little bit of upward pressure here on that inflation print, which certainly would continue to pressure the 10-year yield at that 4.3 level and potentially higher. And certainly looking at this chart here, a breakout above 4.3 does not look at all out of the question, which certainly would be a bit of a headwind for equities if that were to happen. TLT, long-term bonds, we continue to see this trade against this trend line and at risk of pulling back below this $92 support level here on TLT. This is one that we're paying attention to because a sell-off here would be a strong bear signal here for overall equities, a risk-off signal. Dollar index last week, we talked about the fact that decline below 103 is more likely a bit of a overshoot here of this range-bound move, and that's exactly what we've seen here as a range-bound motion on the dollar index. And my expectation is that you could trade just higher on that 105 area here on the dollar index and potentially continue to consolidate here between 103 and 105 on the US dollar. Gold. This was the big breakout here a couple of weeks ago above that $2,100 level to new all-time highs. We've consolidated for nearly a week now. I think the setup here is very clearly bullish here, and the consolidation actually, in my opinion, provides an opportunity for investors to establish new long positions here for GLD, for gold miners. However you choose to gain your exposure to gold, the consolidation range provides an opportunity for you to seek some long exposure here in gold, especially when the risk to reward is quite favorable here. WTI oil. This is the contract that we're referring to here last week. The fact that we broke out above the $79 resistance level here. This has been a resistance for many months, this particular level. We actually talked about the breakout a couple of weeks ago that failed, but we've gotten the follow through here last week. And I think based on volume, based on what we've seen here overall, this breakout, in my opinion, will likely stick and see some further upside. We continue to see energy as a sector outperform all of the sectors right now, and that's an interesting dynamic. But this is on the back of the breakout here that we've seen in oil, and we'll take a look at the chart here for XLE, the sector ETF, as well. So doing a quick sector review here, technology, we continue to see technology actually underperform the S&P 500, so really not going far with regards to the overall sector, and that means we're underperforming the overall sector. Now, the underperformance here is not for very long, so I do think that this is not the sector where I believe that there's going to be a longer period of underperformance. I think the shorter period of underperformance that we've seen does provide a better entry for risk to reward for a lot of traders. So that's something that we are going to explore here in the next few trading sessions. The big one that I think is worth paying attention to is consumer discretionary. Consumer discretionary as a sector has really gotten nowhere since December of last year. And notice that from a relative performance to the S&P 500, the discretionary sector actually peaked last year in the middle of the year. So despite the fact that the price action still looks sideways, the relative performance is extremely poor, and we actually had XLY print a new low relative to the S&P 500 earlier this week. That is not strong here. We would really look to see for consumer discretionary to start showing some outperformance in order for this market rally to have a better shot at continuing. We do have quite a few consumer discretionary stocks reporting this particular week. You have FedEx, you have Lululemon, you have Nike, and then I believe you have a couple of other consumer discretionary names that are reporting this particular week, retailers that are reporting this week. That might provide a bit of a boost here overall to consumer discretionary, but the overall trend here for that sector does not look strong. And that's not particularly good for the US economy when 70% of our US economy is consumer spending or consumer driven. To see this particular sector fall behind on a relative basis is not a strong outlook, in my opinion. A couple of other, I think, sectors worth noting. Healthcare, worth noting the fact that, a defensive sector at the moment is still underperforming here, as you can see, trading near 52-week lows relative to the S&P 500. Materials is one of the sectors that has continued to outperform here. As you can see, not only has it broken out on an absolute basis, but on a relative basis, it's starting to outperform the S&P 500. We talked about this sector last week. We're continuing to talk about the sector because of the outperformance, and there is still some further upside here in these specific names in materials. Industrials, very similar, but as you can see, even though we've broken out on an absolute basis from a chart perspective, on a relative basis, industrial has not outperformed the markets. And that's why between the two sectors, when you're choosing opportunities, in my opinion, basic materials will likely create a better opportunity than in the industrials stock at the moment. The big one I want to talk about here is energy. Energy, as you can see, is trading near its 52-week high around $91. This has been coupled with some pretty significant outperformance here relative to the S&P 500. And this is the type of setup that I believe has the potential to break out higher here and see some further upside here from XLE. We've already seen a lot of the strength here in terms of XLE over the past few weeks, but this is really where I think the geopolitical tensions have continued to change and pressured oil prices to the upside. And at the moment, Saudi Arabia is responding by ramping up production, and we'll see kind of how that influences oil prices going forward. A couple of other sectors worth paying attention to is XHB, home builders breaking out to new relative highs and absolute highs. As you can see here, that's been confirmed. The breakout here to the upside has not only been on the absolute basis, but on the relative basis as well, and also semiconductors. The outperformance here of semiconductors has seen a bit of a pullback here. Overall, as you can see, the trend is still very much up and to the right with regard to the outperformance, but we certainly are at an opportunity for semiconductors to start outperforming again. But this is one that is currently at risk because we are basically at the trend. However you choose to draw your trend lines, this is at risk of a break here, both on the absolute basis, but also on that relative basis, at risk of potential breakdown here. So when we look at AI leading this market rally, we do see some concerns here overall with regards to how we're looking at these specific sectors. So I'll leave you with a couple of charts that I think are worth paying attention to here. First chart I'll pull up here is Marriott. We've started to see this roll over a little bit with regards to kind of the outperformance here relative to the market. That outperformance is currently coming to an end. As you can see, even though we're making new absolute highs, the relative highs to the S&P 500 continues to underperform, and that is potentially at risk of this move higher here to the upside. We see a similar setup here in Home Depot as well. Basically higher highs in price being no longer confirmed by momentum. We have a bit of a double top here around that 385 level, but really the more important thing is the relative performance to the overall market that has continued to underperform, and we're seeing some signs of exhaustion here to the upside. And then when you're looking at opportunities to the upside, it's really, only at the moment energy that stands in regards to upside momentum, upside potential here. ExxonMobil recently breaking out from that 105 level really has the potential to get up to that 118 level here to the upside. With ExxonMobil, it is currently short-term a little bit overbought. This is one that, if you have the patience to wait for a little bit of pullback here, that's really the opportunity that I see here to the upside. Many of the energy names have a chart that looks very similar here to Exxon, where we've kind of completed a bit of a bottoming formation, whether that's a head and shoulders or inverted head and shoulders or other type of bottom formation. You'll notice that a lot of other names have completed a similar type of pattern and are exhibiting that upside target here based on the bottoming formation. But energy names is really the space where we are seeing those types of upside opportunities and far and few in between, given where markets are currently trading near their all-time highs. Not only are markets overbought from a statistical perspective, they're also expensive from a valuation perspective. So cheap stocks to buy at the moment, not easy to find. But the ones that are there are really kind of more so in the energy space that align with both our technical and fundamental view. Otherwise, the discretionary stocks like Marriott, Home Depot, those are the ones that we're starting to see some cracks form in the strength that we've seen from those stocks and those sectors. that are currently at risk of this overall rally. So those are just some closing thoughts to leave you with some charts to pay attention to here. With that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of a start to your week, and I will see you guys here next week. Thank you so much.